Welcome to our overview of why Guyana's next decade matters. We're asking a practical question: what might the economy look like in 10 years? Instead of hype, we'll track signals you can observe, like energy production, jobs, prices, public spending, and investment. Forecasts are uncertain, so we'll speak in ranges and conditions, and focus on what could go right, and what could go wrong. To understand the path ahead, start with the baseline. For years, Guyana relied on agriculture, mining, services, and public administration, supporting a small population and limited domestic market. Offshore oil changed the scale of possible national income, but it also increased exposure to a volatile global commodity. Add in infrastructure gaps, a developing financial system, and shortages of specialized skills, and you can see why spreading growth beyond energy is a real challenge. Now the potential growth engines. First is trade and logistics. Better ports, roads, and drainage can cut transport time and lower costs across the whole economy. Next is human capital. Technical training and practical education help local firms compete for contracts in maintenance, accounting, security, and supply. Add more reliable, affordable power and digital payments, and small businesses face less friction. The key test is broad job creation, not just bigger headline GDP. But strong growth can be derailed. One risk is oil price volatility, which can swing government revenue and private investment. Another is inflation if spending rises faster than the economy can supply housing, labor, and materials. Execution matters too. Weak procurement, delays, or uneven enforcement can waste resources. And climate exposure is structural. Flooding and extreme rainfall can damage assets, disrupt logistics, and raise long-run maintenance costs. To organize uncertainty, use 3 scenarios: bear, base, and bull, built around ranges, not promises. In the bear case, weaker oil prices or project delays combine with low spending efficiency and bottlenecks, so growth slows and inequality pressures rise. In the base case, production expands roughly as planned and public investment steadily improves roads and power, lifting living standards but leaving capacity constraints. In the bull case, strong institutions, workforce training, and diversification let non-oil sectors grow faster and volatility is better. When you look at sector charts, treat them as illustrative ranges: low, base, and high, not an official forecast. Energy may stay the largest GDP contributor, but a high GDP share doesn't automatically mean a large job footprint. Services can expand as incomes rise and supply chains deepen: transport, finance, retail, and professional services. Construction may surge early with housing and public works, then normalize. Agriculture and mining can grow modestly if productivity and processing improve, and spending quality shapes public services outcomes. To close, use a simple watch list to see which scenario is forming. Track oil volumes and global prices, plus inflation and housing costs. Watch employment, especially new jobs outside oil, and non-oil exports and business formation. Check infrastructure delivery, projects finished, maintained, and working. Follow training outcomes and fiscal rules that smooth spending over time. The recap: Guyana could grow very fast, but the durable win is diversification, stability, and broad-based opportunity.